Okay, guys, so we are now here going to look at the extended. And so with that, I will now open and show you guys my positions. Again, I chose to take out of the money calls in this specific account or in this specific market condition because of the limited downside with the exponential upside. And so here we can see that the return on MU, I originally put in, where are we? 530 or so dollars, which now has more than double that position. And so now we're going to go ahead and open up the options chain and look at how we came up in structuring that position. I do believe during this time it's important that if you do want to trade as income, it's important to, in my opinion, pay yourself every 2 weeks. If you are moving more to maybe a money management or hedge fund position, then maybe wait till the end of the year to pull out money so you can have that recorded returns through the end of the year. But with that said, we're going to go ahead now and look at MU options and why I particularly structured around out of the money calls under these circumstances. So my strike price here is for MU is $75. We are now at $63, and it has 3 or 4 more months of we have 2 more months or so, almost three, until the expiration. When I double the call price, if it is an out of the money call, I often do unload almost half or maybe a third of the position. That way the rest of the trade is free. Obviously, I regret doing that with NEO. So do your own due diligence. I don't want to go into it a ton in this video as to how to scale that. I might launch a class where it will go over that. But with that said, we are going to go at least 3 months out in the opening of any position, because you can always close the account earlier. You can always close the option early if it hits your target, but if it expires worthless, then you lose all of your money. So we're gonna go ahead, and the first thing we're gonna do is we're gonna go to at least 3 months. So it would be April. And then we see here the open interest, which is what I like to see right away. And so we do see a lot of open interest here with the 60 call. Again, I use open interest as an indicator. I do not trade off of open interest, but we can see quite a bit of open interest here at the 60 call strike, and then a lot of interest here at the 70, and a little bit less at the 80. So we can see that the sentiment seems to be quite bullish. Inversely, looking at pullbacks, there's not a lot of activity. We have 8K here at 60 strike. We have 6K at 37.5 for a pullback. So something we could also consider is buying these really cheap puts in case of unexpected catalyst move that can very much be a massive risk reward in terms of that. But I don't even believe that there is demand at around the $37 price. No, I mean, let's go down to the daily. Yeah, no. So we're just gonna get away from that. And so now, how are we going to structure what strike are we actually going to get into? So one thing that I like to see is how exponential the move was in correlated industry. So the first thing we're going to do is we're going to see how NVIDIA has moved during some of these announcements. And so the first thing I like to see is in a 3-month span, which is what I'm going to get into, 3 months. What can NVIDIA actually accomplish, or correlated sectors? Principal, or first and foremost, we would start with MU. So let's look at the biggest up move in MU within a 3-month span. So this is March, April, May. So let's look at March and July. It did almost double in price, but that was COVID. So then let's look at 8, 9, 10, 11. And again, it did another 50%, which means that even though we're at an all-time high in 3 months, if all things go as we have seen cyclically in this particular pattern, we could possibly expect a 50% move, at which point this would be roughly $90. Now, obviously, this is a quote-unquote gamble in the sense that price has never been there, so it could not get there. But again, go considering that we may very well be going into a bullish market and the tech sector and the tech industry and how things like Nvidia have moved, it's worth considering that in terms of your risk reward if you do have the capital to spend it in something like an out of the money call, which I like to tell people that is essentially your quote unquote gambling money. In the same respect, during these conditions, it is a good thing to consider out of the money calls because you do have the limited downside if the market free falls. Whereas, so if you buy an in the money call during this market condition and the market free falls, you lose that much more because you're also losing all of the intrinsic value. And so let's look now at Nvidia and let's see what a 2-month move has been at Nvidia. So let's go 3, 4, 5, 6. So this has been 14%. And then 7, 8, 9. So here in 2 months, it did do 50%, and it's kind of been there. So obviously, it's a much larger market cap. So now let's just look at AMD finally. And let's look 3, 4, 5, 6. That was an 83% move of AMD. And then let's look at here 723, 8, 9. Here in 2 months, it did another 50%. So all in all, I'm comfortable going out of the money with MU, which is actually what I did. This is going back to a trade I already took. And so with that, we're going to now go back to MU, and now we're going to consider if it moves along the rest of the sector, we could possibly expect a 50% upside move-ish in the next 3 months. So at which point, then we can look at the risk reward accordingly. So let's go to April, and here we can see that I have a rough target of maybe $90 with MU if things go as they have been. And so here is obviously already at the money. Here we're spending, because it's a $65 strike, it's all extrinsic, it's all fluff, right? It's all extrinsic value that you're buying. So it looks relatively expensive to me versus buying it outright. Of course, you don't have the overnight risk unless you bought it outright and then bought a put accordingly, which may actually be the best position. I will not go into that in this video, but if you're interested in that, let me know and I will do so in the comments below, or maybe tomorrow or something like that. And so we're going to go ahead and now I am comfortable with the 75, which is what I ended up getting. This is 144 days, so this is double expectancy. So in this here, it could actually theoretically double in price. So let's look at what the so it goes from, let's see if there's something in between. Nope, there's not. So we're gonna do either 50 days, which I really don't like unless they're super cheap. No, I don't like the 50-day move. So let's go ahead and then consider what our risk reward would be if we spend $3 at a 75 strike, and let's say we had a price target here in 2 months, roughly at, let's say, 70%, given that it's moved relative to the other ones of 50 or so percent. So it could maybe double by this time, which would be 120. We could, but let's be conservative and say $100. If that was the case, then we may be risking $3 here with the break-even price of $78, adding the out of the money call price plus the $75 for a reward of roughly 30. This is a 10-to-1 per contract to consider, or the 80, which has an 82 break even. So I want to go over now. Let's say that we want to risk $1,000. $1,000 here would be roughly 3 calls. If these 3 calls go to 100, we're going to go ahead and basically take that $78, and then $22 is will put us at $100. So then it will be roughly $2,200 times 3, $6,000 at $100 target for $1,000 risk. So that's a 6-to-1 or so. Whereas to here, if we wanted to risk 80 with $2, we would do an 82 break-even price, but would have 5 calls. at 5 calls times 20 or so dollars that it would be worth, we would have 85 times 2, that would be 18 times 5, that would be roughly 10-ish thousand dollars minus 2, so it would be like 9,000. So in this case, that we would be looking at a potentially 9-to-1 risk reward. So let me just run the math with that. Let's see, let's do calculator. So if we want to risk $100, we're going to do, or if we want to risk 1,000, excuse me, then we would do 3 calls at $75. So then so then the break-even price for that would be 78.10, let's say. So 78, or so let's do 100 as our target minus a break-even of 78.10. Oh wait, 100 minus 78.10 equals, God, clear, 100 minus 78.10 equals $2,100. So in this case, a 300, so okay, so times 100 shares equals 2,100 times 3 contracts is $6,500. So this is a 6.5 to 1 risk reward ratio. If we did the 80 at $2 and let's say here the bid and the ask, let's just say the mid would be 80, let's say 82.10. So 100 minus 82.10 equals 17 times 100, because it's 100 shares per contract, and we can afford 5 contracts with $1,000 risk, times 100 equals 17 times 5. So yep, $8,900. So like I said, roughly $9,000. So this is an 8.9 risk reward for that same $1,000 risk. So this looks like the better trade, but you can kind of get the idea. You can do all that, so on and so forth. Once I go into the 85, and so I'd rather stick with the more conservative number and actually get a good fill, or actually convert them into intrinsic value. And so that's how we can calculate this particular move. So with that said, guys, I hope you found this video helpful. Again, nothing I say is a buy, sell, or hold recommendation. You can lose all or more of your capital trading and investing in the financial markets. This is simply for entertainment and educational purposes only. Thank you guys so much for watching, and I will see you guys next time. Bye.